There are some myths floating around out there, crypto misconceptions that are sometimes so pervasive that they tend to last for eons. Some of these myths may be obvious to you, but some may have flown right under your radar. And by still believing these myths, you could be completely oblivious to their impacts on your portfolio. In this video, I'm going to go over the top 10 crypto myths that exist to this day. I'm going to explain how they came about and why they are myths. All of this is to try and help you invest more wisely, counter that mainstream FUD, and better understand the crypto markets. So, be sure to stick around.
I know it would be nice to give financial advice, but that's not what I do. I must make it all quite plain. I only educate and entertain, if that's all right with you. The timestamps down below are there to help you skip around if that's what you want to do. But may I just remind you all, this video's more discoverable if you watch the whole way through.
Well, if you're still here after that, good on you. If you're a Frank Sinatra fan, you may want to go and lie down for a little while. Now, if you're new here, you may be wondering what the hell is going on. Well, I am Guy, the crypto guy, and I can assure you there won't be any more singing. Over here at the Coin Bureau, we cover everything crypto, from news to reviews, coin overviews and market analysis. It's all available on our platter of knowledge. If that's something you would like to avail yourself of, acquaint yourself with that subscribe button. Tap that bell as well to make sure that you don't miss a single vid. Crypto markets move fast after all. Finally, I would like to direct your attention to the video timeline. As you can see, I've broken it up into numerous sections so you can skip around to the myth that interests you the most. Alrighty, are we ready to roll? Let's start with perhaps one of the biggest misconceptions out there. That is the thought that cryptocurrencies can make you rich. That all you need to do is find the next Bitcoin, throw in a few $100 and ta-da, you're a modern-day Buffett. This is also a narrative that's commonly pushed all across the internet, from YouTube to Instagram, TikTok to Twitter. It's not only that, but we also commonly hear stories about actual crypto millionaires. Those who were able to get on the Doge wave over a year ago and are now sitting on a fortune. The problem with this narrative is this. Even if these stories of crypto millionaires are all true, they are few and far between. You're much more likely to hear about the one guy who made $1 million than the 100 who lost their shirts. This is down to the common logical fallacy of survivorship bias. People don't tend to advertise their losses, and they're not lionized as much. The problem with this is that it creates false expectations for those entering the space. They're investing based on outcomes that are rare. They're more susceptible to manipulation based on these preconceived notions. When they don't become a millionaire in a year or two, they get disheartened and abandon their crypto journey, which is sad to see. Now, I'm not saying that you can't become a millionaire by investing in crypto. It is possible, and there are many that have done this. However, from most of the news flow and clickbait that I see, the narrative is slanted away from the statistics. Pro tip, the more a coin is shilled as a coin that can make you a millionaire, the more likely it is to do the exact opposite. So, avoid those. That's the first myth. I know I may be dampening some hopes here, but it's important to get that one out of the way. The second myth that I want to talk about is closely related to the first, and that's the notion that the best way to generate quick gains is through crypto day trading. The problem with this is that daily crypto moves are incredibly hard to read. They're idiosyncratic and often don't follow predictable trends. It's therefore much harder to read and effectively trade than if you were to focus on a weekly or monthly time frame. Not only that, but trading too often means that you're going to increase your trading fees exponentially. These can build up quite considerably, and these will of course impact on your longer-term profitability. Some of the most successful crypto investors that I've met employ a more strategic buy and hold strategy. It doesn't mean that they hodl for an eternity and never sell. They just have a more disciplined, discretionary approach to their investing or trading. Now, I personally only trade 2 or 3 times a week, and there are some occasions where I don't trade for days on end. This seems to work for me, and it means that I place more weight on each transaction. I'm more deliberate about the transaction, and am certainly not doing it on a whim. This does not mean that profitable crypto day traders don't exist. There are a few, but they are the exception and not the rule. And when a newbie trader can't make their desired return from day trading, they tend to turn to another really dangerous activity, and this actually takes us on to our next myth. There's a belief out there that in order to increase your trading returns, you have to engage in leverage. This is risky in general, but even more so with cryptocurrency, which is way more volatile than other assets. Using leverage of up to 100x on an asset that can fluctuate up to 20% in a day is a recipe for disaster. However, there is a narrative out there that seems to say leverage trading is a quick way to multiply your gains. However, the sad reality is that most retail traders end up getting absolutely wrecked by highly efficient liquidation engines. In fact, there's evidence that retail traders who engage in high leverage are more susceptible to getting liquidated. Now, I'd like to direct your attention to this research piece by the guys over at Carnegie Mellon University. It's a pretty illuminating study that analysed the futures data over at BitMEX. The TLDR of the report is that small leverage traders are more likely to get liquidated because of the way they're using the futures markets, directional. This is in stark contrast to the largest whales like institutions and miners who are hedging and are hence market neutral. Now, I don't have time to go over the whole report, but I've linked to my Telegram post I did on it a few months ago. That's also below. I should also point out that this report does not even cover the potential for broader market manipulation by spot whales in the futures market. Dump the spot market to liquidate over-leveraged longs and pick up more coins. Works every time. Now, this actually ties into my next myth pretty well, and that is around the structure of the crypto market and who actually controls it. There seems to be a common misconception out there that retail traders are able to move crypto markets, that because of their collective size, they're able to impact the direction in which prices go. However, in reality, the bulk of crypto trading volume, especially for the more liquid cryptocurrencies, is controlled by large investors, institutions, etc., our proverbial whales. I want to draw your attention to this blog post that was published by Chainalysis last year. They basically analysed the exchange deposit activity of 340,000 active Bitcoin traders. What they found is that retail traders who deposit less than 10K make up over 96% of all the transfers that are sent to the exchanges on a weekly basis. However, those professional traders control the liquidity of the market. They accounted for a full 85% of all value that was sent to the exchanges. So, to word this another way, 4% of the active day traders in the Bitcoin markets accounted for 85% of the liquidity. Chainalysis was then able to conclude that because of this, these professional traders were the most significant contributors to the pandemic price crash that we saw last year. Now, the reason why I think of this as a myth is the fact that many retail traders think that the markets are likely to move based on the news that they would perceive to be bullish, that the markets should be driven by headlines and social sentiment. However, at the end of the day, about 4% of the traders in the Bitcoin market determine whether it's a good or bad day on that market, and they are driven to trade based on other factors. This also, of course, opens up the question to whether these larger whales could use their considerable heft to play the retail market. It's an interesting thesis, and it's one that I've covered more in depth in my vid on the Wyckoff method. I'll leave a link to that in the top right in case you want to watch it later. Now, I don't mean to scare anyone, of course, but I just want to make you aware of the fact that the crypto markets can be influenced by those with the most capital, as is the case with almost all tradable markets out there. On to my next myth, though, and this is less about unrealistic expectations and more about hopeless FUD. The next myth on our list relates to Bitcoin's impact on the environment. It's something that has been increasingly seen in the news ever since some well-known personalities have begun talking about it. Elon Musk. Of course, it's not only eccentric billionaires that have spread this narrative. You also have the likes of politicians in Elizabeth Warren and comedians in Bill Maher. Of course, with such headline-grabbing names, you can be sure that the headlines ran with the same myth. Now, this is a myth because it is, quite simply, untrue. For example, according to this CoinShares report, Bitcoin mining gets almost 74% of its energy from renewable sources. Yes, that much. Want to hazard a guess as to how much general power users get from renewables? Only about 26%. So, on a comparable basis, Bitcoin mining uses almost 3 times more renewable energy than the bulk of all energy use globally. With those stats, I somehow find it hard to understand why there's been so much hullabaloo about Bitcoin mining. Everything else that you're using power for is drawing from fewer clean energy sources than Bitcoin mining does. I also happen to think that the percentage of Bitcoin mining that's likely to come from renewable sources is likely to increase. This is for 2 main reasons. Firstly, you have to consider the fact that Chinese miners are being driven out of the country in droves. For those that don't know, a large proportion of Chinese mining was done in provinces like Xinjiang and Inner Mongolia, which use dirty coal. With these miners moving to other locations, that reliance on coal-powered mining is likely to decrease. Not only this, but it's also likely that Bitcoin mining could help spur a green energy revolution. This is because energy demand for Bitcoin mining could make it more profitable for energy suppliers to build solar and wind plants. I can't go into all the details here, but I covered it in depth in a recent video I did dispelling this FUD narrative, and you can watch that in the top right. It's time for my next myth though, and it's closely tied to that point about China. I now want to talk about the myth that Bitcoin is centralized and controlled by China. This is mainly because of the fact that a great deal of the mining hash rate has historically been in China. This FUD has existed for a number of years, and it's often an argument that's used by opponents of Bitcoin when talking about decentralization. It's also been picked up pretty recently by a well-known car salesman, Elon Musk. Sorry guys, I've just got this weird cough that just won't go away. Most irritating. Where was I? Yes. Decentralization FUD. Well, what people need to understand is the difference between the Bitcoin network and the miners on the network. The network itself is a collection of nodes that store the Bitcoin blockchain. Miners, on the other hand, are the participants on the network that propagate blocks and process transactions. Just because most of the miners are located in one country does not make the network centralized. In fact, if we were to take a look at the geographical distribution of Bitcoin nodes across the world, it's incredibly decentralized. There are over 13,000 nodes across the globe, all based in numerous different locations, as far south as the southern tip of New Zealand to as far north as Iceland. It's this decentralization of nodes that makes Bitcoin uncensorable. There's not a single server or point of failure that you can lean on in order to disrupt the network. So this is the reason that I get so hot under the collar when people claim that Bitcoin is centralized. And even if the mining were centralized, like I said earlier, this is likely to change soon. That's because of that Chinese government crackdown on mining. Chinese miners are fleeing the country in droves, and they're looking to set up their operations in a number of other more accommodating jurisdictions. I talked about this in great detail in my video about Chinese mining, so feel free to watch that after this one by hitting that link in the top right. Anyways, this point about centralization ties in nicely with our next myth about crypto, and that is that governments can shut it down. No joke, I was at a breakfast the other day, and someone told me that they were wary of cryptocurrencies because governments were more than likely to clamp down on and eliminate them. I mean, I don't really blame them too much for thinking that. There have been countless headlines in the past about this or that government trying to ban Bitcoin. More recently, you've had countries from India to Nigeria, Turkey to Russia. They've either floated the idea of banning cryptocurrencies or introduced supposed regulations. The only problem in their plan is that it physically cannot be done. As I explained, most cryptocurrencies like Bitcoin, Ethereum, etc. are a network of decentralized nodes around the world that run open source software. What exactly are you going to ban? Anyone can spin up a node anywhere in the world and keep records of that decentralized ledger. It's also really tough to be able to determine who is running these particular nodes. This is all thanks to other anonymizing technology like VPNs, etc. Just to point out how hard it is to actually ban cryptocurrency, China has been trying ever since 2017, and it's still failed to do so. Now, this is a country that has an internet firewall system literally called the Great Firewall of China. If it cannot stop users from sending crypto or running nodes, then you can be damn sure no other country will be able to. The only way that countries could ban and eliminate cryptocurrency fully is if they shut down the entire internet globally. If they made it impossible for anyone to connect and run a node. Not a scenario I'm losing sleep over. That's perhaps why many of the countries that have tried to take stances and ban cryptocurrencies have failed. They've realized that it cannot be done. I actually talked quite a bit about this in my video on Bitcoin bans a few months ago, when India and Nigeria were considering it. As I predicted in that video, they would soon realize just how fruitless their attempts were and they would give up. I should of course point out that there is a difference between banning crypto and banning fiat crypto on or off ramps. Governments have realized that the only way that they can slow the adoption of cryptocurrencies is to make it tough for people to easily convert their crypto into fiat. Given that centralized exchanges interact with the traditional financial system, they have become a target for these governments and regulators. However, even if the government makes it tough to convert crypto into fiat and vice versa on a centralized exchange, people can always resort to peer-to-peer transactions. In other words, a simple exchange between two people, no government permission needed. There is a reason why countries like Venezuela have seen such massive explosions in local Bitcoin peer-to-peer volume. Where a buyer meets a seller, a crypto transaction can take place. So that's the myth of government bans. It's still quite pervasive in no-coiner circles. And speaking of well-known no-coiner myths, another really common one is the notion that crypto is mainly used by criminals for nefarious purposes. The reason that this gets me so angry is because not only is it dismissive, but it tries to paint everyone who uses crypto with this negative brush. It's also incredibly ignorant, as anyone who's studied the crypto space for more than a day will know how vast and fully legitimate it is. Yet again, I don't fully blame them, mainly because the news that they're watching likes to publicize hacks, ransomware, and other headline-grabbing stories. But headlines are clickbait and stats are facts. Let's take a look at some stats, shall we? According to the blockchain sleuths over at Chainalysis, the total percentage of crypto transactions that was involved in criminal activity last year is less than 0.5% of all transactions. That's down by almost a quarter from the level in 2019. So to put that another way, 95.5% of all crypto transactions were legitimate. Transactions where people were engaging in payments, DeFi, staking, trading, and other perfectly respectable use cases. I think one of the main reasons as to why this myth has been able to last so long is because of another common crypto myth, and that is that Bitcoin transactions are anonymous. Let's move on to that one, shall we? There are far too many people that have the misconception that Bitcoin transactions are private, that it allows people to engage in nefarious activity because the transactions cannot be traced and because there are no identities on the blockchain. Not only is it a narrative that's still pushed by the mainstream media, but it's also commonly used as a reason to further clamp down on cryptocurrencies by the politicians and regulators. This narrative is patently false. What you should know is that Bitcoin is in fact less private than cash money. That is because all of the transactions on the Bitcoin network are fully traceable. It's a transparent ledger, which means that any Bitcoin that was ever used for illicit activity can always be identified. Similarly, every single wallet on the blockchain has a public address that is open for everyone to watch. They can see what transactions are flowing into and out of this address. Now, while it's true that you don't have to have a name to that address, all you need to do is to link it to a real-world identity to be able to determine who is behind it. This is usually at the point when the person behind that wallet tries to interact with an exchange, etc. You should also know that there are blockchain auditing firms out there that have become so advanced in tracking Bitcoin transactions that it's actually riskier to use than other methods like cash. You only need to take a look at all of the headlines about hackers getting busted because the authorities were able to easily trace their transactions and find out who they were. In fact, these tools have become so advanced that they've even been able to stop funds that are going through numerous wallets. This recently happened with that Colonial Pipeline hack, where the FBI was able to seize the Bitcoin before it even made it out of a cloud server. The ease with which Bitcoin is so easily traced is also another reason that some coins from very high-profile hacks have not been moved for years. An example of this is the Bitfinex hack, where even the smallest movement in funds from that 2016 hack attracts loads of attention. Having said this, though, there are cryptocurrencies that were developed specifically for anonymity. These include the likes of Zcash and Monero. I can't go into the full details here, but feel free to watch my most recent video on Monero, and you know where to go for that good stuff. Now, you'll notice throughout this video that I've been talking about Bitcoin and other cryptocurrencies interchangeably. And that's because of the next myth on our list, one that has been pushed by a maximalist school of thought. According to the die-hard maximalists, there is only one true cryptocurrency that will last, and that is Bitcoin. They have the view that it's the only cryptocurrency that will be needed in the future and can be used for all of the use cases that other cryptocurrencies have been developed for. Take the case about Monero above. Maxis will say that there is anonymization tech like CoinJoin, etc., that can be used to protect the privacy of Bitcoin users. The only problem with this is that it's in no way comparable to the tech on Monero. It is opt-in privacy, and it's not easy to use. Or how about smart contracts and Ethereum? Yes, with the Taproot upgrade, it will be possible to code some more advanced scripting into Bitcoin transactions. But this is incomparable to the immense functionality someone has with Solidity-based contracts on Ethereum. There is a reason that nearly every single popular DeFi protocol out there is built on Ethereum. It's not even just about raw functionality, it's also about scalability. Given the fact that Bitcoin is the granddaddy of crypto, its technology is nowhere near as advanced as some of the cryptocurrencies that we're seeing today. Also, given how much is at stake on the Bitcoin network and how many participants there are, it's incredibly hard to get updates approved and implemented. For example, Taproot has taken years and only just got the required support by the miners in order to be pushed. This means that Bitcoin is becoming less practical as a currency or medium of exchange. It's increasingly seen as a store of long-term value. Now, don't get me wrong, I love Bitcoin and it makes up a large part of my portfolio. I just don't think that it's able to solve all our blockchain use cases, and it won't be the only cryptocurrency in the future. That's it for my top crypto myths, a solid collection that covers everything from no coin of FUD to crypto market misconceptions. Now, there are many more of these misconceptions and myths out there that I may have to come back and revisit in another video. However, I must stress the importance of relying on multiple sources and fact-checking when it comes to everything crypto-related. There is no doubt that there's a mainstream narrative of crypto that often runs up against the truth. If we were to rely solely on what we read in the news or see on social media, we'd be making decisions and coming to conclusions based on substandard information. If the Bitcoin OGs had listened to the narrative back throughout the years, they would have sold their stack and sat in desperation as the price defied the doomsday headlines. There's a saying in Bitcoin that goes, "Don't trust, verify." The same can be said when it comes to crypto information. Now it's time to hear your thoughts on these myths. Are there any that I've missed? Let me know in the comments. And while you're down there tapping away at that comment, I absolutely have to let you know about my socials page. It's over here where I've linked to all the other places that you can follow me off the tube. These include my Telegram Insider channel with daily market updates, the only official one, Twitter for announcements and the occasional story, Instagram and TikTok for behind-the-scenes fun and memes. And finally, my weekly newsletter. It's here that I share my crypto tips as well as a breakdown of my personal portfolio. So, be sure to head down below and hit that top link in the description. If you liked this video, then share that like. Make that like button blue and don't forget to subscribe too. Oh, and the bell. Don't forget it or it will get lonely. You don't want to miss what else I have coming down the pipes, folks. So till next time, crypto guys, gotta fly.